Welcome to the deep dive. We are looking at a story today that serves as, well, it's essentially a masterclass in aggressive scaling, corporate restructuring, and the sheer mechanics of legacy.
hmm
And if you were looking at the official Apple Podcast metadata for today's show, the title would read, Harcourt's History, from an 1888 New Zealand startup to a global real estate empire, the deep dive.
Right, that really sums it up.
It does, and the description we've put together says, Welcome to the deep dive. In this extensive exploration, we unpack the fascinating 130-plus year history of Harcourt's International, one of the leading names in the global property market.
Yeah,
Discover how a small 1888 Wellington business transformed into an international franchise powerhouse managing over $58 billion in property. We explore their pioneering 19th century marketing tactics, massive corporate restructurings in the 1980s, and their aggressive expansion into the Australian real estate market and beyond.
it is a massive scope.
It really is.
Yeah.
Plus, we impartially examine the complexities of managing a massive franchise network, including recent regulatory proceedings and Commerce Commission investigations. So, whether you are a real estate professional, a business history buff, or just a curious learner looking to understand the mechanics of a multinational property empire, this deep dive provides all the essential insights to keep you perfectly informed.
I love that summary because it really is a phenomenal case study.
Yeah.
When you look at the survival rate of corporations over a century, the attrition is just staggering.
Oh, absolutely.
To not just survive from 1888 to the 2020s, but to completely reinvent the operational model multiple times.
Shifting from a private family firm to a publicly traded entity.
Exactly. To a bank-owned asset, to a management buyout, and finally into a massive decentralized franchise network. I mean, it requires an extraordinary level of strategic agility.
Okay, let's unpack this. We have to start at the foundation to really understand the DNA of this company. The timeline kicks off in Wellington, New Zealand, and the central figure here is John Bateman Harcourt. He establishes the Harcourt's real estate company in 1888. But his prior career is what actually sets the stage for everything that follows.
Yeah, his merchant background.
Exactly. From 1874 to 1879, he was a partner in, and then eventually the sole owner of, a merchant firm called A.P. Stewart & Co. So he spent over a decade dealing in the trade of physical goods before pivoting to real estate.
And that background changes the entire complexion of the founding.
Yeah, how so?
Well, he wasn't arriving at real estate from a background of, property management or architecture. He was approaching it purely as a trader.
Right.
In the 1880s, New Zealand's economy was highly reliant on the flow of commodities: wool, meat, timber. A merchant operating at a high level in Wellington at that time was essentially a master of arbitrage.
Just constantly moving goods.
You are constantly assessing the delta between supply, demand, and intrinsic value. So when Harcourt moved into real estate, he simply applied that highly commercial, liquidity-focused mindset to land and physical infrastructure.
He viewed property as a commodity.
Yes, not just as shelter, but as a tradable asset class that required market making to thrive.
And you immediately see that market-making approach in how widely he diversified his initial portfolio.
Definitely.
If you're starting a real estate firm today, the conventional wisdom is to find a niche, right?
Oh, absolutely. Riches in the niches.
Exactly. You dominate high-end residential in a specific zip code, or you focus strictly on commercial leasing. But Harcourt did the exact opposite.
Which casts a very wide net.
An incredibly wide net. His early portfolio included city properties, country estates, seaside locations, mining properties, working farms, and station properties.
Wow.
Plus, they operated a highly active auction house. So was this simply a lack of focus, or was this a calculated necessity for a frontier market?
It was absolute necessity and, frankly, brilliant risk mitigation. Think about it. In the late 19th century, the New Zealand economy was prone to massive, localized shocks. If you only sold city residential properties, a localized credit crunch could wipe out your entire revenue stream overnight.
Oh, I see.
By holding a portfolio that spanned agricultural land, mining interests, and urban real estate, Harcourt effectively created an internal hedge.
So if one sector tanks...
As the others keep you afloat.
Hmm.
If the pastoral sector took a hit due to international wool prices, perhaps the mining sector or urban commercial real estate was still liquid.
That makes a lot of sense.
Furthermore, leaning heavily into the auction mechanism is pure merchant behavior.
Right, the option house.
An auction is the most efficient price discovery mechanism available. It forces liquidity in markets that might otherwise remain stagnant, which was critical when dealing with highly variable assets like a 19th century mining claim or a remote sheep station.
He was building an economic shock absorber, basically. But here is the piece of early strategy that I find genuinely remarkable. In the 1880s and 90s, Harcourt's introduced a publication called the Register and Property Investor's Guide.
Yes, the register.
It was circulated monthly throughout Wellington, and they were hitting a volume of roughly 4,000 copies per month.
That is a staggering number for the time.
Right. This wasn't just a flyer. It was the equivalent of an authoritative blue book for the regional property market.
What you are looking at there is the creation of a proprietary data moat executed with 19th century technology.
A data moat.
Think about this. Long before the internet, this was aggressive, high-volume content marketing. Producing 4,000 physical guides a month in that era was not a trivial expense.
Not at all.
The typesetting, the printing, the localized logistics of distribution, it required a significant capital outlay and dedicated operational infrastructure.
Right. So what is the actual return on investment for that massive operational headache? Is it just brand awareness?
It goes much deeper than brand awareness. It's about establishing absolute market authority and creating information asymmetry in their favor.
Okay, unpack that a bit.
In an era before standardized multiple listing services or digital databases, information about property values and availability was highly fragmented. It was word of mouth.
Right, you had to ask around.
Exactly. By aggregating that data and pushing it to the market, Harcourts positioned themselves as the centralized clearinghouse for market intelligence.
They became the source of truth.
If an investor is relying on your guide to understand the market, they're invariably going to execute their trades through your brokerage.
Because you're the ones holding all the cards.
Yes. It lowers customer acquisition costs over the long term because the publication does the heavy lifting of lead generation and trust building before the client even walks through the door.
That's brilliant.
It is a highly sophisticated play that we see modern proptech companies attempting to replicate today with automated valuation models and neighborhood market reports.
It's fascinating that the underlying strategy of aggregating and controlling market data hasn't changed, just the delivery mechanism.
Human psychology doesn't change.
Very true. But a visionary founder eventually has to step away. And as we move into the 20th century, we hit that classic vulnerability point, the generational transition.
Always a tricky time.
By 1905, his sons, Stanton and Gordon, are in the business. But it wasn't a seamless multi-generational dynasty.
No, it really is.
In 1929, the business actually splits. Gordon leaves to set up Gordon Harcourt Ltd., while Stanton remains at the helm of the original Harcourt & Co.
This raises an important question. We see this structural fracture so often in family enterprises, usually occurring at the second or third generation mark.
Why is that?
When you have two siblings operating under a structure built by a dominant founder, you often hit a ceiling on leadership bandwidth. There's only so much room at the top.
Yeah.
The 1929 split is intriguing primarily because of the timing.
Right, 1929.
You were right on the precipice of the Great Depression.
Exactly. Splitting your capital base and your operational resources right before a massive global economic contraction seems incredibly risky.
It is deeply risky. But it also speaks to differing strategic visions, or perhaps just the absolute necessity of operational autonomy for both brothers.
They just needed their own space.
Yeah. For the original Harcourt & Co., it meant Stanton had to consolidate his operations and navigate the 1930s without the combined resources of the broader family unit.
Which is a crucible.
It forces a company to rely on the strength of its underlying systems rather than sheer size.
And Stanton manages to steer the ship for decades, right through the Depression and the Second World War.
That's no small feat.
Not at all. But the true test of institutionalizing the business comes in the 1950s.
Ah, the transition.
Yes, Stanton retires, and leadership transitions to a man named Heck Fisher. This is the first time the company is headed by someone outside the immediate Harcourt family tree.
That is the crucial inflection point, where a business proves it has intrinsic value beyond its founder's surname.
Moving from a family business to a corporate entity.
Transitioning to professional non-family management often brings a necessary ruthless objectivity to the operation.
Because they aren't tied up in the family drama.
Exactly. Family businesses can suffer from legacy inefficiencies. Retaining underperforming business units out of sentimentality or promoting based on lineage rather than merit.
Right, keeping Uncle Bob's failing division open just because it's Uncle Bob.
Precisely. Bringing in external leadership like Heck Fisher typically signals a shift toward corporate modernization. It lays the groundwork for scaling beyond the original geographic or operational boundaries set by the founders.
And we see the fruits of that modernization a few decades later. 1980 is a watershed year for the company.
It's a big leap.
They expand operations into Auckland, New Zealand's largest commercial hub, and simultaneously announce their listing on the stock exchange.
You don't make those two moves simultaneously without a very aggressive growth mandate.
They were ready to move fast.
Expanding into Auckland from Wellington isn't just opening a new branch. It's entering a highly competitive, larger market that requires serious capital for marketing, talent acquisition, and infrastructure.
Which perfectly explains the public listing.
Precisely. An IPO in 1980 provided the war chest needed to fund that national expansion. But it fundamentally alters the governance of the company.
Wow, so?
Well, you were trading operational privacy and long-term strategic patience for immediate liquidity and the relentless pressure of quarterly earnings reports.
The shareholders want their returns.
The public markets demand compounding growth. You can't just run a comfortable, profitable regional firm anymore. You have to feed the beast.
And they absolutely fed the beast. The period following that IPO, specifically from 1985 through 1992, is a masterclass in aggressive, almost chaotic corporate restructuring.
It was a very wild era for corporate finance globally.
It really was. In 1985, they merged with Collins Real Estate to form Harcourt's Real Estate Ltd.
That merger is a classic market consolidation play. When you enter a new tier of national operation, acquiring an established player is often cheaper and faster than fighting trench warfare for market share point by point.
You just buy the market share.
It instantly scales their footprint and brings new executive talent into the fold, which sets up the next major phase.
Right, because Stephen Collins becomes a central figure here. In 1988, he orchestrates two monumental shifts. He introduces the franchise model to the company, and he takes it public again, or at least heavily restructures its public listing.
Okay, yes.
But the ownership structure immediately turns into a game of hot potato.
It does.
The National Bank of New Zealand becomes a major shareholder and actually leads the company back into private ownership.
Let's pause and really look at the mechanics of this, because it is highly unusual.
The bouncing back and forth.
Yeah. A franchise model is highly capital efficient for expansion once it's rolling. But the initial setup, drafting the legal frameworks, standardizing the operational manuals, building the centralized technology and marketing support, is incredibly capital intensive.
So going public makes sense to fund that setup.
Yes, but for a major retail bank to swoop in and take it private, that signals something very specific about the perceived value of the asset.
What were they seeing? Were they just looking at the cash flow from the franchise royalties?
It's likely a combination of reliable cash flow and strategic synergy. A real estate franchise network is a massive distribution channel for financial products.
Oh, of course. Mortgages.
If a bank owns the real estate network, they have direct, first-touch access to thousands of home buyers who are going to need mortgages, insurance, and retail banking services.
They catch the customer at the absolute source.
The bank probably saw Harcourt's not just as a property firm, but as an incredibly efficient customer acquisition engine for their core banking products. By taking it private, they avoided the regulatory headache of managing those synergies under the scrutiny of public shareholders.
But the bank abandons the play almost immediately. In 1989, just a year later, Tower Corporation, which was a massive player in the insurance and financial services sector, buys the shares from the National Bank.
Tower Corporation stepping in confirmed that thesis. They were a financial services giant looking for distribution networks.
Same strategy, different player.
However, integrating a decentralized, highly entrepreneurial real estate franchise network into a rigid corporate insurance hierarchy is notoriously difficult.
Oil and water.
The cultures clash. Real estate agents are highly autonomous. Corporate insurance is highly standardized.
Which leads us directly to 1992. The corporate marriage clearly didn't hold because Stephen Collins, Paul Wright, Bob Cooper, and Joanne Clifford execute a management buyout.
The MBO.
Yes, they pull the company out of Tower Corporation's portfolio and take it completely private.
A management buyout in 1992 is a bold maneuver. The early 90s economic climate wasn't exactly a boom time. There were significant recessions globally.
Right, interest rates were all over the place.
To execute an MBO, this management team would have had to secure substantial debt, likely leveraging the future cash flows of the franchise network to buy out Tower.
So why take on that massive personal and financial risk in that economic climate?
Because of agency theory. When a company like Harcourt is owned by a massive conglomerate like Tower, the parent company's capital allocation priorities rarely align perfectly with the subsidiary's needs.
They're a small fish in a massive corporate pond.
If Tower needed to shore up its insurance reserves, it might starve the real estate division of the capital needed to innovate or expand.
I see.
Collins and his team likely realized that the franchise model they built in 1988 was being throttled by corporate bureaucracy. By executing the MBO, they aligned ownership directly with operational control.
Removing the red tape.
If they wanted to reinvest 100% of profits into a massive new technology play, they no longer needed approval from an insurance board of directors. They controlled their own destiny.
And having that total control allowed them to make what is arguably one of the most prescient technological investments in real estate history.
This is a huge turning point.
In 1996, they launched the first national, public, searchable online property database in their market.
We have to remember the technological landscape of 1996.
Dial-up modems.
The consumer internet was barely functional by modern standards. Real estate was still entirely reliant on print classifieds and physical window cards. To build a national searchable database meant they had to completely re-architect how their hundreds of independent franchise offices handled data.
That sounds like a logistical nightmare. Every office probably had their own completely siloed way of recording listings.
Exactly. Before you can even build the website, you have to build the internal centralized data pipeline. You have to force independent business owners, your franchisees, to adopt a standardized software system for data entry.
Getting real estate agents in 1996 to use a centralized computer system.
It's like herding cats. Then you have to host that data on expensive centralized servers and build a front-end consumer interface that works over 28K modems.
Huge investment.
It was a massive upfront capital expenditure with no immediate guaranteed ROI because consumers weren't even accustomed to looking for houses on a computer yet.
So why do it? Was it a defensive move or a purely offensive strategy?
It was a highly aggressive offensive strategy that established a massive competitive moat. By being first to market with a national digital inventory, they captured the early tech adopter demographic.
Setting the standard.
More importantly, it revolutionized their value proposition to potential franchisees. If you are an independent agent in 1996, deciding whether to join Harcourt's or stay independent, the fact that Harcourt's can automatically syndicate your listings to a global digital audience is an undeniable selling point.
It's a massive carrot.
It accelerated their franchise recruitment exponentially.
And that technological infrastructure, that ability to standardize and centralize operations, becomes the launch pad for their next era.
Going global.
The global expansion. By 1997, Mike and Irene Green, who were former Harcourt's franchise owners themselves, initiated the push into Australia. This is a massive leap.
What's fascinating here is that expanding a franchise network internationally is categorically different from expanding domestically.
Because of the distance.
Distance, but mostly regulation. When you cross the Tasman Sea into Australia, you are entering a market with deeply entrenched domestic competitors and a highly complex regulatory environment.
Right.
Australia isn't a single monolithic real estate market. It's a federation. The property laws, trust accounting regulations, and agent licensing requirements in Queensland are completely different from those in New South Wales or Victoria.
So you can't just take the New Zealand operational manual, slap a new cover on it, and hand it to an Australian franchisee.
Not at all. You essentially have to rebuild the compliance and operational architecture for each individual state while maintaining the core brand identity and technological backbone.
That sounds incredibly tedious.
The fact that the expansion was spearheaded by the Greens people who actually operated franchises on the ground is likely why it succeeded. They understood the practical friction points of the business model.
They knew the pain points.
They knew what support a local office actually needed from the corporate parent to thrive in a highly competitive new market.
Yeah. And the success of that Australian beachhead catalyzed unbelievable global growth. The scale they operate at today is difficult to comprehend.
The numbers are wild.
We are looking at an organization with over 6,000 team members worldwide, operating out of 860 offices.
Incredible.
They are entrenched in 11 countries. This includes major markets like South Africa, China, Hong Kong, Indonesia, Fiji, Mexico, Canada, and the United States.
And the financial metrics attached to that footprint are staggering, transacting $50 billion worth of property in a single year and managing a rent roll of $58.8 billion across over 106,000 properties.
How does the corporate entity even govern a network of that size? You have 860 distinct businesses operating in 11 different legal jurisdictions, all bearing the same brand name.
It requires a highly sophisticated, multi-tiered corporate structure. A franchisor operating at that scale is no longer really in the business of selling real estate.
What are they in the business of then?
They are in the business of logistics, brand management, and regulatory compliance. They have to provide enterprise-grade technology platforms that can handle multi-currency transactions. They have to run global marketing architectures that can be localized instantly. And they have to enforce draconian quality control to protect the brand equity.
A brand is everything.
The local franchise manages the relationships and the actual property transactions. But the parent company provides the structural skeleton. If that skeleton fractures, the whole network collapses.
And speaking of that structural skeleton, there is a major corporate shift currently underway.
Yes, the 2025 announcement.
In 2025, Harcourt's announced an intention to apply to be removed from the New Zealand company's register. Their stated strategy is to become incorporated under Australian law, with the ultimate holding company, Harcourt's International Betty Ltd., based in Brisbane.
This is a monumental pivot for a company with 130 years of New Zealand heritage.
A huge deal for the brand's identity.
When a multinational redomiciles its ultimate holding company, it is a highly calculated maneuver driven by macroeconomics, tax efficiency, or capital market access.
What's the specific advantage of shifting the legal center of gravity to Brisbane?
Australia represents a vastly larger domestic market and pool of capital than New Zealand. By incorporating as an Australian entity, they may be streamlining their tax structures, simplifying their regulatory reporting, or positioning themselves for easier access to Australian institutional investors or debt markets.
Following the money, basically.
It's an acknowledgement that while their history is Kiwi, their economic engine is increasingly driven by the Australian market and the broader Asia-Pacific region. It formalizes where the center of power and capital truly resides within the organization today.
If we look closely at how they structure the actual product offerings across that massive international footprint, it's not just a single homogeneous Harcourt's brand stamped on every single office.
No, they've diversified.
They have developed a highly deliberate ecosystem of subsidiary brands. There's NAI Harcourts, which handles commercial sales and leasing. They have Nutrien Harcourts for the rural and regional markets. Mortgage Express is their financial services arm, and Luxury Property Selection targets the ultra-high-end residential tier.
What you're describing is a strategic pivot from a branded house to a house of brands, or at least a hybrid model. In real estate, consumer psychology varies wildly depending on the asset class.
Right, the person buying a multi-million-dollar industrial park has completely different expectations than someone buying an agricultural station.
Exactly. If you try to serve both of those clients with the exact same marketing materials, the same agent profiles, and the same operational language, you end up appealing to neither.
Jack of all trades, master of none.
Commercial real estate is highly analytical, driven by cap rates and yield. Rural real estate requires deep knowledge of water rights, soil quality, and livestock capacity.
Highly specialized knowledge.
By carving out NAI Harcourts and Nutrien Harcourts, they allow their specialists to operate with dedicated resources and bespoke branding that resonates with those specific consumer cohorts. It provides the localized expertise of a boutique firm while retaining the centralized back-end power of the global franchise.
And managing the quality of the agents operating under all those different banners requires massive internal infrastructure. Back in 2002, they established the Harcourt's Academy, which operates as a registered training organization.
That is entirely about quality control and liability mitigation. When you have 6,000 independent contractors interacting with the public under your brand, your legal exposure is astronomical.
Any one of them could make a massive mistake.
The Harcourt's Academy isn't just about teaching sales techniques. It's a central mechanism for ensuring uniform compliance with evolving property laws across different jurisdictions.
Keeping everyone aligned.
By running it as a formal registered training organization, they mandate a baseline of professional competency that protects the parent brand from localized malpractice.
They also built out a massive philanthropic arm. The Harcourt's Foundation was launched in 2008. They've raised millions of dollars and supported over 1,340 charities, heavily supporting initiatives like Gumboot Friday, Hospice New Zealand, and Beyond Blue.
Corporate philanthropy in a franchise network operates slightly differently than in a traditional centralized corporation. A franchise network is inherently decentralized. Its power lies in its deep integration into local communities.
The agents live in the neighborhoods they sell in.
Exactly. The Harcourt's Foundation provides the centralized administrative and legal framework for charitable giving, but the actual fundraising is often executed by the local franchisees in their specific neighborhoods.
It's a localized ESG strategy.
Precisely. It allows the local business owner to build deep, authentic goodwill in their immediate market, while the parent company aggregates those localized efforts to demonstrate massive corporate social responsibility on a global scale. It's incredibly effective both for the charities involved and for building long-term brand equity.
And building that brand equity ultimately culminates in establishing consumer trust, which is highly quantifiable for them.
They track this very closely.
They've aggressively cataloged their awards, voted Reader's Digest Most Trusted Real Estate Brand consistently from 2013 to 2024, winning Quality Service Awards from 2018 to 2024, and securing the 2025 Finder Awards for Australia's most recommended real estate agency.
In high-ticket, low-frequency transactions like real estate, trust isn't a soft metric. It is the primary driver of revenue.
It's everything.
Consumers transact property maybe 3 or 4 times in their entire lives. The information asymmetry is massive, and the financial stakes are existential.
It's the biggest purchase most people will ever make.
Those third-party trust validations, like a decade of Reader's Digest awards, act as an immediate anxiety reducer for a prospective vendor. It drastically lowers the customer acquisition cost for the local agent sitting in the living room trying to win the listing. If the brand enters the room pre-validated as most trusted, the agent's job is significantly easier.
However, maintaining that universal trust across hundreds of independent operations is an ongoing battle. And the sheer scale of the network inherently invites intense regulatory scrutiny.
It's unavoidable at that size.
Looking at their operational record requires examining some significant legal and regulatory challenges they've faced. To be clear, we are unpacking the historical and legal facts of these cases as they stand, exploring the mechanics of how these situations arise in a market of this size.
Regulatory friction is an inevitable byproduct of massive market share. When you command a significant percentage of national property transactions, regulatory bodies like the Commerce Commission monitor your strategic moves with a microscope.
A prime example of this is the 2016 case brought by the New Zealand Commerce Commission. Harcourt Group Limited was one of 5 major national real estate agencies involved.
The others being Barfoot and Thompson, L.J. Hooker, Ray White, and Bailey Corporation.
Correct. The proceedings centered on a price-fixing arrangement regarding how the agencies passed on Trade Me advertising costs to vendors. Harcourt's was ultimately ordered to pay a penalty of 2.575 million New Zealand dollars.
It was a very significant case.
Let's break down the mechanics of this. Why did advertising costs lead to a massive price-fixing penalty?
If we connect this to the bigger picture, this case is a fascinating look at platform economics and vendor funding models. In real estate, the marketing costs, like listing a property on a dominant online portal such as Trade Me in New Zealand, are typically passed on to the vendor, the person selling the house.
Right.
If a dominant platform suddenly raises its listing fees significantly, agencies are faced with a dilemma. Do they absorb the cost and compress their own profit margins, or do they pass the increased cost directly to the consumer?
And if one agency passes it on, but a competitor absorbs it to win the listing, it creates a massive competitive disadvantage.
Exactly. So in a highly competitive market, there is an intense temptation for the major players to communicate and agree. We will all universally pass this new cost onto the vendor, so none of us loses our competitive positioning.
Leveling the playing field for themselves.
But the moment independent competitors agree to coordinate their pricing strategies, even regarding third-party supplier costs, they cross the line into cartel conduct and price fixing under the Commerce Act. It's a textbook example of how a coordinated response to a dominant supplier can trigger severe antitrust penalties.
That concept of cartel conduct leads us directly to a much more recent open case.
Yes, the 2025 announcement.
In September 2025, the New Zealand Commerce Commission announced civil proceedings alleging cartel conduct specifically in the Christchurch real estate market. This action involves Harcourt Group Limited, alongside 4 specific franchisees: Four Seasons Realty 2017 Limited, Gold Real Estate Group Limited, Grenadier Real Estate Limited, and Homewood Real Estate Limited. The matter is currently open under Section 30 of the Commerce Act 1986.
This open case highlights the ultimate vulnerability of the franchise model. We talked earlier about the tension between the centralized parent company and the independent local operators.
The franchisor versus the franchisee.
In a franchise network, the local offices are horizontal competitors. They are legally distinct entities that are supposed to compete aggressively with each other for listings and market share, even if they share the same branding.
So if the managers or owners of those independent franchise offices in Christchurch sit down and coordinate their market behavior, whether it's regarding commission rates, marketing packages, or how they interact with competitors, they are engaging in horizontal agreements.
Precisely. And if the Commerce Commission alleges cartel conduct, they are investigating whether those independent business owners colluded to restrict competition in their regional market.
It's a massive risk.
For the parent company, Harcourt Group Limited, the legal and reputational exposure is profound. They have to demonstrate whether they had oversight, involvement, or if this was purely localized behavior that breached their internal compliance frameworks. Managing antitrust compliance across a decentralized network of fierce, independent salespeople is an incredibly complex operational challenge.
We also see the complexities of local execution and how individual offices handle disclosure and consumer information. In early 2026, the publication staff reported on an incident involving a specific office, Harcourt's Gold Redwood.
Disclosure is always a flashpoint.
According to the report, the agency initially declined to disclose a buyer commission building inspection report to other prospective buyers at an auction after that report had been provided to the agency.
This touches on the intense legal and ethical obligations surrounding information asymmetry in property transactions. When an agency comes into possession of material information regarding a property's condition, like an adverse building report, the regulatory framework in most jurisdictions dictates strict rules regarding the disclosure of that information to other potential buyers.
The media report noted that after questions were raised, the agency confirmed it would disclose the report, and a complaint was subsequently lodged with the real estate authority.
It perfectly illustrates the tightrope local agents walk in high-pressure auction environments. They have a fiduciary duty to their vendor to achieve the highest possible price, but they have an overriding legal and ethical obligation not to mislead buyers by omission of material facts.
And when they slip, the whole brand feels it.
When a local office stumbles on that tightrope, the media headline doesn't just name the specific independent agent, it names the massive global brand. The parent company spends millions building a most trusted reputation, but that reputation is tested every single day by thousands of independent agents making split-second decisions about disclosure in local markets.
It is the ultimate double-edged sword of massive scale. You aggregate the capital, the technology, and the brand power of a $58.8 billion network, but you inherently aggregate the localized risk of every single office.
That's a trade-off.
When you step back and look at the entire arc, the evolution is stunning. We've traced the journey from a 19th century Wellington merchant using a monthly printed guide to build a regional data moat through the chaotic corporate restructuring and public listings of the 1980s.
It's been quite a ride.
We've unpacked the foresight of launching national digital databases before the internet was truly mainstream and analyzed the immense logistical and legal architecture required to transplant that model into Australia and ultimately across 11 countries.
A phenomenal transformation.
The next time you are driving through your neighborhood and you see a real estate sign staked in a front lawn, I want you to look past the local agent's headshot. Consider the massive, invisible infrastructure operating behind that sign. Think about the centralized technology platforms, the complex franchise agreements, the international holding companies, and the century of corporate evolution required just to facilitate that single local transaction.
And that evolutionary trajectory leaves you with a final thought to really ponder.
What's that?
As real estate becomes increasingly digitized and globalized, with AI-driven property valuations, automated marketing, and frictionless digital transactions, will the 130-year-old model of local community-based franchise offices survive the next technological leap? Or will the very concept of the local agent be entirely redefined in the coming decades?
That is exactly the kind of question this history forces us to ask. Thank you for joining us as we unpack the massive scale and complex history of Harcourt's International. We will catch you on the next Deep Dive.